Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow. Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on myself for my monthly Random Ramblings podcast. Let's see. Before I tell you the topics I want to hit today and everything, let me just get started with a quick disclaimer. Remind everyone, nothing on this podcast is investing advice. That's always true, particularly true today because A, I obviously have no clue what I'm saying about a variety of topics, and B, I'm going to be going through a bunch of different topics and stocks. I have an idea of what I want to talk about today. I don't think I'm long any of them. I'll try to disclose if I talk about any stocks I'm long, but whether I'm long or have no position, just remember, not investing advice, consult a financial advisor, all of that type of stuff. So anyway, today there are three topics I want to hit on today's Random Rambling. Those topics are kind of the returns, risks, perils of when you're only focusing on one stock or one industry. That's number one. Number two is I wanted to provide some thoughts on probabilities and weighting and how people value them and terminal zeros. And then number three, I wanted to talk about the returns on fame and how they continue to increase and how I kind of think it relates to the margin of safety in a good business. And in particular there, I'm thinking about sports, but then I'm also moving it over to good businesses. So let's dive in. First thing I was thinking about today, if you're very online, I don't consider myself very online, but if you're on Twitter, if you're on FinTwit, if you're talking to a lot of investors, you will talk to investors, and this applies to both retail and institutional investors who kind of are just 100% devoted to one stock or maybe one company. And on the retail side, I think of the more positive side, Constellation software. You'll hear people talking about Constellation software nonstop, and you'll hear people like, it was partly because of compounding. If you invested in Constellation 10 years ago, you've gotten there. But, I know people who started buying it in 2022, 2023, and they're like, this is the next Berkshire. It's the Berkshire of software. Berkshire Hathaway is another one. And you'll talk to people who have huge percentage of their portfolio in it. And they're like, look, this is going to be a compounder for a long term. And again, consult a financial advisor, not recommending anyone take huge percentage of their portfolio or anything. But there are others, right? I know a group of investors who all they focus on is tobacco. Of course, energy. People who only focus on energy stocks. When it comes to stocks, I think of on the retail side, the meme stock, there were people who were 100% focused on AMC. For years, I knew people who, I know a lot of people who were really focused on Paramount, or think of Bruce Berkowitz with Sears. He basically became a fund of one with Sears and maybe the Fannie Mae, Freddie Mac preferreds for a while. Like I can think of these people, SoftBank, SoftBank has a cult following, Fairfax has a cult following, Merkel has a cult following, obviously Berkshire has a cult following. And these companies have a cult following, but I'm more thinking of the investors who have, you talk to them, they're like 80% of my net worth is in Berkshire. Again, not a recommendation, just saying what people do. And what I've kind of been wondering, when someone focuses that much on one company, one industry, deep water drilling, oil, tech companies, crypto, whatever it is, I wonder what the returns to that are, right? Obviously, there's going to be heavy selection bias. I think of Bruce Berkowitz with Sears. That goes not basically to zero, that did go to zero. And that's going to define / really impact your career. But that's a negative example. But you could think of somebody who 10 years ago went all in on Constellation software, or I know people who 10 years ago went all in on Bitcoin and they don't have to worry about anything anymore. So I guess I wonder, hey, if I were to focus on this one group of investors who they just become obsessed with one investing topic, and they're just it's all they focus on. It's all they think about. I wonder what the returns would be. Again, I think there are heavy selection and survivorship biases there, because if you were 100% all in on Sears 10 years ago, nobody hears from you today anymore, right? But if you were 100% all in on Bitcoin, then you're retired on a beach. So I think there's heavy selection bias, but my gut would say I think they tend to outperform. When somebody just gets so obsessed with the company and they think the opportunity is so big, it's all they think about. Like, I just kind of think the incentive systems, the incentive and the conviction behind that, I think it probably means they're onto something. But I don't know. I'd be really interested if anyone has studies or anything. But I think about this a lot. I can get really obsessive with the investments I do, and I don't run clearly 100% concentrated. But you start thinking about this when you're concentrated. Like, hey, if over the past 2 years, let's say your best idea has performed your best over the past 2 to 3 years and consistently, it's like, hey, am I pulling the Charlie Munger and diluting myself down by investing in my second, third, fourth best idea? But what if your second and third best ideas have performed swimmingly and your best idea hasn't performed? Like, I'm just very interested. I'm interested in the conviction to get there. I'd be really interested in the returns, because if you're going to invest really heavily in one company, one stock, you're going to focus on it a ton. You're going to be digging through it. I talk to some people who I'm involved in companies where I have, let's call it a 5% position, which nobody would say a 5% position is small, and they've got 100% position in it. And I would just say, like, when I talk to them, they are reading the tea leaves. Like, they've got the CEO's wife followed on Facebook, and if she likes something, they're thinking about how that impacts. Like, did the CEO say, if she likes something, a news article, they're like, hey, did the CEO tell her what's going on? And she's liking that news article because she knows how it's going to relate to the company and their net worth and their future and sending their kids to college. It's a really interesting thing. Now, sometimes I also think, what I said just now is kind of crazy. And it's like, hey, the CEO's wife liked this purse brand. Is it because they're about to sell the company for a fortune and she'll have the money to buy a high-end purse? And you're kind of like, no, man, she just likes purses, there's nothing really there. So anyway, that's my thought. Again, this is random ramblings. I rambled a bit, but I just always wonder about that. Is there signal? Is there noise? Like, if I know 3 smart investors who are all over one topic, I generally want to spend time on it. But am I underrating that as a signal? Am I overweighting it? I'm just very interested there. Let's turn to probabilities and terminal zeros. One thing you can hear it in the pod. You can hear it a lot. If I talk to an investor and I say, I think there's a 60% chance of this thing happening, and I often mean that in an event-driven merger arbs sense, right? There's a 60% chance of this merger going through, but there's other ways you can imagine it on fundamental basis for a lot of things. If I say 60%, I just feel like people are willing to give that thing value. If I say there's a 40% or 30% chance, I think there are a lot of people who kind of dismiss that and say, I need to get paid for that as a free option. I need to zero that. And obviously both are, if something's 51% versus 49%, they're effectively priced at the same thing. But I find if I say 51%, people will give that credit because it's more likely than not to happen. If I say 49, a lot of times they're like, oh, I kind of want that option for free. And the thing I wonder about there is, I'd be really interested, is there any returns? Is there any data on how long shots versus short shots in the stock market work? Because I would imagine that if I gave you a basket of things that I thought had a 25% probability, and I gave you a basket of things that I thought had a 60% probability, imagine the 25% would be undervalued and the 60% might be slightly overvalued. Now, the reason I suspect there's not any research on that is because a lot of the percentages, it's almost never so black and white that you can assign it, right? Like, I'm kind of putting that probability. If it's a merger arb, like, I have to say what's the downside, and that's very suggestive. There's a lot of assumptions that go into that, right? If I say, hey, if the stock breaks, I think it's going to 10. I can't tell you how many times I've seen a deal break that I thought would go to 10 that touched 2, or that went to 20. So there's a lot of assumptions in there. But I'd be really curious because it's something I try to break. But just based on a lot of my talks, if you say something's lower probability, investors want to assign it as 0 odds, and there's clearly value there. And if you say it's higher probability, investors almost start thinking like it's 100% odds. And obviously, neither is correct. Look, this is not just investors. This is a very well-documented behavioral bias that humans have, but it's something I've been thinking about. And one way I've kind of been thinking about that there is things that have a risk of going to a terminal value of 0. The obvious ones here would be coal miners or smoking, anything that touches nicotine, right? Like if you're making legacy cigarettes, those are getting taxed into oblivion. Your core customer base is dying. Like it's probably a sunset industry, but as I love to say, what a beautiful sunset it can be, because these things can be very profitable. Go look at the cigarette stocks over the past 30 years. They've done great. Coal mining, same thing. But I've been really interested in things that have high chances of being a terminal zero, like a coal or smokers. They've outperformed over the past few years. Some of that is energy policy specific, when it comes to the coal miners, but a lot of sin stocks have outperformed. And I suspect a reason is because it's so obvious that they have terminal value risk there that investors have kind of over discounted them, right? I've been curious about things that have what I'll call long shot terminal value risk. So something like an Uber is a really interesting example, right? Self-driving comes along, and there is a very good chance that Uber is a terminal zero, right? If Tesla cracks the self-driving code, there's a very good chance that Tesla is running their own network. They're sending self-driving cars to you. Uber could be a zero in that scenario. I'm not saying it will be. There is a world where the Uber kind of customer layer and data is extremely important in a self-driving world. But there are worlds where self-driving cars take over and Uber is just instantly a zero. But because self-driving is still a long way off and we don't know how that plays off, like you can look at Uber's price. It's not priced like it's a terminal zero anytime in the near future. But that's a remote risk. You could think of others. Google, for a while, when AI was coming out, people were saying AI is going to replace Google search. I think that's gone away. I think most of those risks have gone away, but still something. What are some others? I'm not sure. A very visible one, TV stations. I've talked ad nauseum about the kind of key TV stations having the unwind where, as more TV subs leave, the TV stations have to raise their price to justify the fixed costs of all of these big sports leagues that they've signed, which causes more people to leave. At this point, legacy TV bundles is pretty widely regarded their internal decline. So those are very obvious. They trade at very low multiples because of that. But when it comes to probabilities, I wonder, do things with very obvious terminal value issues, very decent chances of having a terminal value of zero, are those kind of underpriced in the stock market just because there are a lot of cash flows between now and then? And often, you think about something like coal, they have much longer tails than I think anybody really expects. Are those underpriced? And maybe things with that remote risk of zero, but there is some risk. Are those a little overpriced because the market says, oh, it's only 1%, so you assign it to zero, but a 1% chance of zero is a big chance of zero. So that's probabilities and terminal zeros. That's been on my mind. Last thing I wanted to rant on. Kind of the way these relates, I call them returns to fame and good businesses. And I'll tell you how they relate in a second. But increasingly in the world, I think you're seeing the returns to fame are increasing, right? So the place I really think about is top NBA players. In the next few years, they're going to be making $100 million per year. Bottom rung players will be making $10 million per year, plus all of it's guaranteed. These are insane amounts of money. The highest paid people in America will be NBA players in the near future. And that's happening because, the NBA is taking in lots of money. And a lot of that money is coming in places, people have always loved sports. 50 years ago, sports, the only place they were getting money was people going to the stadiums, right? That's the only place they were getting money. Then I think they got radio contracts, then you get TV contracts. And now they've got all these partnerships, data. In the past 5 years, sports betting has come on in a big way. But you've got this business that people love. And as the world goes more online, more interconnected, you have more and more opportunities to monetize that. Think about your favorite streaming artist. Taylor Swift is a billionaire now. She's the first billionaire musician. And the big reason behind it, I'm sure the Beatles were bigger than Taylor Swift back in the day. Michael Jackson was probably just as big. But the returns to monetizing, like she gets insane amounts of Capital One money, advertising money. Her tour makes insane amounts of money, sponsorships. She can start her own businesses. You think about what Rihanna did with her brands, or the returns to fame continue to escalate. And it's not just that, going back to sports, I think about an NFL reporter. 20 years ago, if you were the best NFL reporter, right, really the only thing you could do was hope you got hired by ESPN, that would be the top of the job. And ESPN had a lot of market value to that, right? There was only ESPN, Fox, CBS. There were like 4 places that you could realistically look to get hired. And that was all you could really do. Today, if you're a really good NFL reporter or analyst or something, what can you do? It's kind of a booming market. You think about podcasting. I'm podcasting right now, but podcasting, you could go start a podcast, and the money in podcasts is huge. It's a very competitive space because it's so easy to launch one. There are hundreds out there, but there's sports betting money, there's brand money, all of this is advertising looking for homes. So you could do a podcast and go your own route. You could start your own business. You can start a Substack newsletter. You can start your own business. And the ways you can apply your skills are not limited. You could do it on sports betting. You could do it on just general analyst. You could do it as a consultant. A lot of these data teams, they get hired by the teams as a consultant. You could do it for fantasy football. NBA, same thing. People want to pay. And I've just kind of been thinking, like, if you've got something that, if you're really good at something that people love, I think historically you've probably been maybe not under monetized, but the returns to being able to be really good at something people love continue to go up. And that NFL example just really drives it home to me. So how am I thinking about that? One thing I've been thinking about a lot is if you're looking at a really good business, they just tend to have like returns and optionalities that just kind of pop up over the years that really bad businesses don't have. It's hard for me to think of one off the top of my head. Apple, right? Think of Apple. They have this iPhone that is the centerpiece of people, that is the centerpiece of your daily life, right? And if I had been talking to you about Apple 10 years ago, I don't know, maybe some tech people way smarter than me would have been able to figure it out. But 10 years ago, I think you have the iPhone. I don't think it's obvious, hey, we can make this huge market selling really integrated, really high-end headphones, right? I don't know if that's super obvious. Hey, this huge payments opportunity is with Apple cards and everything. That's going to pop up. I don't think that was super obvious. If you think about something like, what else? There's Uber. I mean, it's a little bit different, but you've got this big network of drivers and everything, and you can keep tossing things on top of it, right? Like, hey, it wasn't super obvious that you could do Uber Eats, Uber Delivery, but I think those are starting to make headway. So, you don't have the same thing when you have a Qualcomm. Here's a great example. You have the royalties to, you'll look at companies that have coal royalties or oil and gas royalties, and they have them on huge tracts of lands. If they're really well located, like they just kind of keep popping up, right? Like all of a sudden you come back and the oil wells you drilled 20 years ago because you've got new technology, you go drill there. Or, hey, these are just really well located with resources. Resources tend to cluster. There's water resources here, or you have the rights of way access and all this sort of stuff. So you've got the best building in New York City. 20 years ago, it might have been the best as an office tower. Today, it might be the best as a residential tower. But if it's really pristine location, like it just keeps popping out optionality. The best retail storefronts. Again, 20 years ago, there were tons of banks around. Banks are closing as they go more online and stuff. But guess what? The best retail locations, things just keep popping up and wanting to do it because if you've got a lot of traffic, if you build a lot for brands, it really matters for them. So it's just one thing I've been thinking of. If you showed me $2 and one of them was trading for 60 cents and one of them was trading for 40 cents, in the stock market, and the 60 cents was attached to a good business and the 40 cents was attached to kind of a worse business, I think historically I would gravitate more towards the 40-cent really cheap dollar. But that might not be right. The past 5 years have shown with Facebook, Constellation, Google, all these guys, like they just keep pulling out growth projects and growth capex. Like who would have imagined they're all dominating AI and everything? They just keep pulling these out of nowhere. And it's just, hey, maybe a lot of people have undervalued the optionality from buying good businesses. Obviously, the optionality from having great management team, founder teams. I mean, people have expounded on that a lot. So I won't go through that there, but it's a real thing, right? Like Zuck successfully transitioned from desktop to mobile. He's, obviously I don't think the Reality Labs, the AR goggles and stuff, I don't think that's gone great, but he caught the AI shift. Like he caught the Instagram shift. Like you bet on someone like that, they kind of pull rabbits out their hat. And it's something I've been thinking about with, especially a lot of these smaller companies I look at. If you've got a smaller company that you're looking at that's worth it's trading for 5, you think it's worth 10, but 3 years ago, it was trading at 250 and you thought it was worth 5, and the CEO's done a great job of growing value. Maybe one thing you need to consider is that 10 could very easily be worth 20 3 years from now because the CEO pulls another rabbit out their hat or something. So anyway, I think this was probably the most rambly I've done. I think I've been rambling for about 20 minutes. Look, as always, I appreciate everyone who's listening to this. Feedback, suggestions, everything. I'm always open to them. Shoot me an email, drop me a comment, any of that. I am recording this September 15th. I'm looking forward to speaking to you all at some point in another rambling episode mid-October. And I've got a lot of podcasts lined up for you guys now and then. And I think some of them are extremely good. Looking forward to releasing all of them, and hopefully you will be listening to all of them. So I'm going to go on a run, catch some football, hang with the baby. Looking forward to talking to you all soon. Bye. Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.